It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc, and I am recording live at KCAA 1050 a.m. in Riverside. So pretty excited to be here. It's a great station, and if you're in the Riverside or San Bernardino area, I highly recommend checking this out. Again, it's KCAA 1050 a.m. There's a lot of things I cover on current events and that type of thing, even political things that affect our money. I discuss this all the time on this radio show, as many people know. Today I'm going to go back to the basics a little bit about what is your personal bank and why now is a particularly good time to consider your personal bank as part of your portfolio. There's a lot of reasons behind it, but again, it's where the economy is, where interest rates are, that type of thing. And we have a lot of new listeners with a lot of new stations. We're blessed that this show has gone national, and we're in stations from coast to coast, literally. So if you're a first-time listener or new listener, welcome aboard. Thanks for joining us. So again, the first question is, what is your personal bank? Well, your personal bank is basically a two-step process. And what we're doing is we're taking assets or financial tools, I should say, from two different areas, and we're marrying them together to make both better. And so really it's a strategic alliance, strategically integrating banking and insurance tools. And the key is to continue growth on your funds even after you use those funds for other purposes. In other words, after you spend the money, you can continue to still earn interest. And this is something that makes it very, very unique in terms of the financial world as far as financial tools. A couple of other key things that are different or almost unique is the ability for the money to grow, insured, guaranteed, income tax-free. Not only can you grow the money tax-free, you can access it tax-free and pass it on to your heirs, income tax-free, if it's set up properly. And of course, we do that, obviously. Now, one of the first questions I'll get is all the time, I hear this all the time, is this an annuity? And the answer is no, it is not an annuity, has nothing to do with annuities. Now, I've discussed annuities in other shows, and I'm not necessarily saying they're a bad thing. I'm not against them. There's certainly a time and a place for those. But your personal bank is not an annuity. I want to make that very clear. In fact, what it is, it's a two-step process. We set up a high cash value insurance policy, and it is designed to maximize tax-favored cash growth. Again, we want to grow our money income tax-free. We want to be able to access that money income tax-free. The second step is then we set up a bank line of credit using the cash in the policy as collateral for the loan. This is the opposite of how most people use and view life insurance. And in fact, I'm going to tell you, this is where people, if they miss the idea, if they miss the point, I'm going to tell you what it is right now. And that is, they think of insurance as an expense or a bill, like the car insurance or homeowners or whatever, and they stop listening. And you know what? They miss the whole point. Again, we're doing the opposite of how most people view and use life insurance. And you know what I mean when I explain this. Think of a teeter-totter. This is one of the best ways I've always used to explain this. Put cash on one side and death benefit on the other. And how most people use insurance is they use it as a death benefit protection tool, not as an insurance tool. And here's what I mean, or not as an investment tool. And here's what I mean by that. Think about it when you went to purchase insurance. What's your focus? What's your key goal? Well, what's the least amount of money I can to apply, least amount of premium that I have to pay to get the largest death benefit, right? I mean, that's how almost everyone buys life insurance. You want the most death benefit for the least amount of money. Now, is that life insurance? Well, the answer is no, not really. And why I say that is, if you have insurance on you, will you ever see that money? And the answer is, of course, no, you won't. It's for your heirs. It's for your beneficiaries, for your loved ones, for your business, whatever. In other words, life insurance, it's a nice flowery term for technically death benefit protection. And if you think of that teeter-totter. You put the cash on one side, you put the death benefit on the other. You have the least amount of cash for the most death benefit, right? That's the primary goal most people do. Well, we do the opposite. So think about that same teeter-totter, but we flip it completely on its head. This is not a small change. This is a massive change. We change the cash anywhere from 60 to 90%, depending on how we structure it, how you fund it. There's various ways of doing that, which we'll get into a little bit later. But the point is we're maximizing cash and we're minimizing the death benefit. Now, one of the common misconceptions or objections or concerns I hear all the time is, well, people say, well, you don't want to invest in life insurance because it's expensive. It's got too much fees. Well, if you're going to invest the traditional method of life insurance, again, the least amount of cash, the biggest death benefit, you are going to have a lot of fees. Because think about this a minute. Where's the risk to the insurance company? Well, of course, it is with the death benefit, right? Let me use an example. Let's say you had $1 million death benefit, insurance policy, death benefit on you. What's the risk to the insurance company? It's really quite simple. You get hit by an ice cream truck, they got to write $1 million check to somebody, right? Do you think there's any costs or risk involved with that? And the answer is, of course there is. That's where the cost of insurance comes from. But if we're pushing the cash up by 60 to 90%, we're actually pushing the death benefit down by 60 to 90%. What does that do? That reduces the cost of insurance by 60 to 90%. And oftentimes we run into scenarios where the cost of insurance now is competitive to like many mutual or index funds, things like that. So it gets very competitive on the fee side of things. Because again, the goal is not to maximize death benefit. The goal is to maximize cash growth. We want our money to grow. We want to maximize dividends or interest credits, whatever that is. And we want to maximize that money because we want our money to grow. It's just that simple, just like any other investment tool. We want our money to grow, but the advantage here is, as I stated earlier, is you can grow your money insured, with guarantees, and income tax-free. Not only grow it tax-free, you can access it tax-free, you can pass it on to your heirs tax-free. And that's another key point on the tax side of things I need to share with people. There is a difference between tax-deferred and tax-free. It's a big deal, a big difference, and you need to understand. IRAs, 401ks, qualified plans, those types of investments, primarily the traditional ones, are tax-deferred. Most annuities are tax-deferred. What does that mean? Well, it means as long as you leave the money in the account and you do not make any withdrawals, the money grows without being taxed. In contrast, to give you an idea, you take a simple example like a typical investment account or a CD, well, let's just take a CD. That's a perfect, simple example of you can earn interest on a CD, of course, year to year, but you do have to pay the taxes on it each year, whether you access the money or not, on the gains, that is. So again, if you are tax deferred, there's a difference between tax deferred and tax free. And the difference is tax deferred is you're kicking the can down the road, so to speak, in terms of paying the taxes, but you do pay taxes on the gains when you access the funds. And if you build up a nice sizable chunk of money, of course, you obviously can have some pretty big tax bills on those types of accounts, those tax deferred. Tax free is what it sounds like. It's tax free. You access the money, money grows tax-free, you access it tax-free. An analogy would be like a Roth IRA. Many people are familiar with those. You can access the funds tax-free. I'll share some differences in a few minutes, probably, the difference between your personal bank versus a Roth, but there's a couple other key things I want to share to understand your personal bank and understand how this works. Again, we set up a high cash value policy to maximize growth, insured with guarantees, tax-free. Now, first thing, before I get to any further on that, is who do we choose as far as insurance companies go? Well, did you know there's over 800 insurance companies in the United States? That's a lot of companies out there. Out of all those, there's about 40 that are what's called mutually owned companies, and you've probably heard of many of these. For Mutual of Omaha, Mass Mutual, Northwestern Mutual, etc. There's a number of them. There's about 40 or so. And why do you want to use a mutual company to grow your cash? Well, it's really quite simple. There's no stockholders with a mutual company. See, if you take a stock company, a stock insurance company, they have stockholders and policy owners. And stockholders, they have to pay them typically a quarterly dividend. So what are dividends, by the way? Profits of a company. So if a company's making a profit and they have stockholders, that means they have to pay a portion of the dividend to the stockholders and the policy owners. So I have a simple question. Do you want all of the dividend, or do you want to share it with stockholders if you happen to own a policy? Well, that answer is very obvious and very simple. You want all the dividend. Well, mutual owned companies, you receive all the dividend if you own a policy with them. Now, out of those 40 or so mutually owned companies, there's about 15 or so that have a 100-year history plus of never missing a dividend. That means they've paid dividends or profits every year for the last 100 plus years. That means they paid them through the Great Depression, both world wars, the Great Recession, you name it, it doesn't matter. They paid dividends straight on throughout. Out of those 15 or so, there's three what we consider the top three dividend payers. They pay some of the highest dividends in the industry and have so consistently over the last several decades. And also, there's three of these companies, those same three companies, by the way, they're sort of the leaders, have never missed a dividend since literally before the Civil War. Let me say that again. Think about that a minute. There's three companies out there that are among the top dividend payers out there consistently for decades, and on top of that have never missed a dividend since before the Civil War. That's an awful long time, folks. All three of these companies are A+ rated, tons of cash reserves, well positioned to continue to pay dividends for the next lifetime, frankly. That's the type of stability these companies have. And out of those, there's one actually that has lower fees than the others. So guess what? Lower fees means more cash or more money to you. Now, if you want to find out which company it is, that's the one thing I'm going to save, because I'm going to encourage you to contact me at yourpersonalbank.com. If you want to know which company it is that's paid dividends for several decades, among the highest dividend payer, lowest fees, and never missed a dividend since literally before the Civil War, I'll share with you those three companies. So again, contact me at yourpersonalbank.com, and I'll be able to answer any questions that you may have. Now that's the insurance side of things in terms of growing the money. We put the money in to earn dividends. We want our money to grow safely, insured, with guarantees, and income tax free. It's pretty straightforward. The second step is when we want to access the funds. There's actually three ways you can access money from these policies, but I'll show you the way to do it on an income tax-free basis. And that's typically by using bank lines of credit. You can also create positive cash flow with your money. I'm going to encourage you to stay tuned to the next segment so that you understand how to do that. I will share how the bank lines further enhance your personal bank policy or strategy so that your money can grow even after you spend money. So contact me at yourpersonalbank.com for more information. Stay tuned in the next segment. You don't want to miss it.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to contact me, you can do so at yourpersonalbank.com. Again, you will reach me at yourpersonalbank.com. So I've been discussing today, what is your personal bank? I'm also going to discuss why today, right now, with the current economy, interest rate environment, everything that's going on, why this is a particularly good time to consider your personal bank as part of your portfolio. If you're listening to the first segment, I was sharing the insurance side of it. What is your personal bank? It's a two-step process. We set up a high cash value policy to maximize dividends on an insured, guaranteed tax-free basis. Then when we want to access the funds, we typically set up a bank line of credit using the cash and the policy as collateral to then access the funds and we can oftentimes create positive cash flow. Notice you keep earning interest on the money even after you spend it. Now, how do you do that? Well, I'm going to share that, so I'm going to really strongly encourage you to stay tuned on this. Obviously, this is a question I get asked all the time. Well, what if I just put the money in and let it ride, let it grow? Well, it's what it's going to do. We've got companies paying 6% plus dividends today, insured, guaranteed, tax-free. And sometimes people say 6%, that's okay, but it's not that great. Remember, it's income tax-free. Depending on your tax bracket, the average American is about a 25% tax bracket right now, and that is state and federal. It can vary, but that's sort of the average. Well, if you're getting 6% tax-free, for example, that's equivalent to 8% before tax. And that's consistent, insured, and guaranteed. How many people are getting 8% guaranteed before tax these days without any risk? That's I don't think many people are getting that these days, especially. So you see what I'm saying? It's very competitive. Here's another thing I want you to understand. Dividends are on the rise because of the increased interest rates. The historical average on dividends, by the way, is about 7 to 8%. I can show you the historicals and you'll see what I'm talking about. I'm going to get into that further, more in depth of why dividends are going up, and we do expect that to occur for the next 5 to 10 years even. So you could be in an investment that's insured, guaranteed, tax-free, and increasing in returns over the next 5 to 10 years easily, while the economy might be stumbling, interest rates are rather high, and inflation is still on the higher side. But before I get to that, I need to share the second step of your personal bank concept. Remember, the first step is setting up the high cash value policy to maximize dividends, maximize growing our money, insured, guaranteed, tax-free. Again, leave it alone, let it ride. It's going to grow like any other account will, any other investment would. But let's say you now want to access your funds. Well, there's actually three ways to take your money out of these policies. One, you can obviously take withdrawals. Just like you could take a withdrawal from any other account or investment. The problem with taking a withdrawal is when you remove money from an account, what's your return on the money that you removed in the future? And the answer, of course, is 0 because you withdrew the money. You took it out of the account. You're not going to earn any interest or dividends or any other growth for that matter on money that's not invested. I think everyone understands that. The second one, so we don't recommend that as an option. You'll see why in a minute. The second way to access funds from these, of course, is you can access or take the dividends. Taking dividends is much like taking an interest off a CD, for example. So you're taking the gains each year and from the account. You can certainly do that, but there's a disadvantage to that, and that is that the gains, if you withdraw those, are taxable. So again, we typically do not recommend that. We do not recommend taking the dividends or interest credits because those can be taxable, and we're trying to avoid taxes as much as possible legally, trying to minimize our tax liability, right? That's what most people want to do. Well, there's a third way you can access. Actually, there's 4 ways. There's a fourth way too, which I'll touch on. So the third way to access funds is you can borrow against the policy. And there's 3 ways to borrow against the policy. 1, you can take a policy loan. 2, you can set up a bank line of credit. Or 3, you can use the cash in the policy as collateral for a loan through a bank. Now let's discuss these 3 options and the advantages of why you want to consider that. For one, loans are tax-free. Why are they tax-free? Look at an IRS 1040 form. There's nowhere on the form for loans. It's an income tax return. That's how you can receive monies through a loan and not be issued a 1099 by the bank or the insurance company or anyone for that matter. No taxable event occurred. Now I'll explain to you how the wealthy use this tool quite often to minimize their taxes. That's a common complaint we hear all the time is how people are saying, well, the wealthy, they make all this money, why are they not paying taxes? Stay tuned the next minute or two and I'm going to share with you why and how they do it perfectly legally. Now, if you set up a bank line of credit, it's a specialized area of lending, and only a handful of banks in the United States offer this type of lending, and familiar with most all of them that do this, and I can recommend some of the banks that offer the best rates at any given time. By the way, there's no cost or fees. There's no loan fees. There's only interest charged when you access the funds. So if we have a different bank, for example, that offers a lower rate, we can switch the banks and no cost or fee to you, and you can always take advantage of the lowest rates available. The rates can vary depending on the size of your account with different banks, for example, but they're typically based on prime, the prime rate, or prime minus, usually prime minus 1%, or something along that line. Prime rate, if you're not familiar with that, is typically considered the lowest rate an individual can borrow money at with good credit. And like I said, we have loans available that are at prime and prime minus. So this is some of the cheapest money you'll be able to access anywhere. The cash, as I stated earlier, is the collateral for the money in the line. Now, this is an analogy this is a question I'm going to ask, and then an analogy I'll share to help understand this further. If you've ever taken a home equity line of credit, you'll understand how this works. Or a cash out refi, for example. In other words, if you take a home equity line of credit out on your property, most people understand that the bank is lending against the equity in the property. That's the equity in the property is the collateral for the loan. Most people understand that. And most loans will loan up to 80% loan to value. Most banks will, I should say. And you can access those funds. Banks will even give you a checkbook if you want, typically. You can do it online, bill pay. The funds are very accessible. There's typically no fees, no cost to setting up the line, and you only get charged interest when you access the funds. So it's highly liquid, highly accessible funds, but costs you nothing to set it up. So it's great for emergencies, unexpected expenses, things like that. This can be a great source of funds, or lines of credit can be a great source of funds, shorter term, typically, for investments or purchasing items or whatever until you can secure more long-term financing. That's how often many people use lines of credit. Now, as long as you access funds through a bank line of credit, I got a simple question. Where does the money come from? Does it come from the insurance company or the bank line? And the answer is really quite simple. It comes from the bank. In other words, remember, you funded monies into a policy to earn dividends. You're growing your money, and let's assume you're making 6% to keep things real simple. And the money grows, insured, with guarantees, tax-free, like I've stated repeatedly. Now you decide to access the funds through the bank line, and remember, the funds come from the bank, not the insurance company. What does that mean? Well, it means, as far as the insurance company is concerned, all the money is still there. It's still earning full dividends, right? And if you're earning 6% dividends, for example, and you're getting charged 5% interest from the bank, what happens? Well, obviously what's happening is you're keeping the difference. In that example, it's 1% positive cash flow or positive arbitrage on your money that you spent. Now think about that a minute. You have the ability to earn interest on money you spent. Can you share with me any other investment tool that allows you to do that? The answer is no, it doesn't exist, really, does it? So my point is simple. You have the ability to earn interest on money you spent, but not only this year, but every year for the rest of your life. As long as you're earning as much or more in dividends and you're getting charged in interest when you access those funds, you have a positive spread. You have a gap or a spread. You're getting to keep the difference. And let's say the difference was only 1%. 1% may not sound like much, but 1% on how much you spend each year could be a lot of money. The historical average of the positive arbitrage or positive cash flow, by the way, is about 2 to 3%. I can show you over the last 40 plus years. But if you're making 1, 2, 3% on money you spent, how much more money would you have in your pocket to live on? Not only this year, but every year for the rest of your life. Folks, that is the key. That is the power of your personal bank concept. That's what makes it unique. You have that ability to do so. But there's some additional advantages to accessing funds through a bank line of credit. And that is, we have banks that give you the option of making payments or not. You have the ability to access funds through a bank line and never have to make a payment, principal or interest. We all know if you take a home equity line of credit, for example, and you access funds from that, you do have to make a monthly payment to the bank. Here, you do not have to do that. So my point is, you can, but there's no requirement to do so. I want you to understand, I'm not saying that necessarily is the best way to go, but I want you to understand that that option is part of that puts you in control of your money. If you don't have to make monthly payments, interest or principal, you can decide when it makes sense to pay back your loan, if and when it makes sense. By the way, if you never pay it back, or which unpaid portion, remember we said earlier the teeter-totter, we're maximizing cash value and we're minimizing the death benefit, our teeter-totter example I shared earlier? Well, here's the thing. Even though we're minimizing the death benefit, there still is one. So the lender, the bank, knows that if you do pass away, they're going to get paid back through the death benefit. And the analogy I can use for you, it makes sense, is let's assume for a minute you had a house worth $500,000. And let's say you had a mortgage against it for $250,000. If you went and then sold that house, the lender obviously would get the $250,000 and you would receive the proceeds. Same principle here. If you had $500,000 cash and you had borrowed $250,000 and you pass away, the bank or the lender would get the $250,000, your heirs would get the rest. Same principle, same how it works. Now, I'm going to encourage you to stay tuned in the next segment because I'm going to show you the best way to operate with these to maximize the growth on your money going forward, even after you spend it. So don't miss it.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. I've been discussing today the Your Personal Bank concept. What is it? I'm also going to discuss today why today, right now, is a particularly good time to consider adding your personal bank in your portfolio. If you wanted more information, before I go any further, you can contact me at yourpersonalbank.com. Yes, you will reach me. Again, it's yourpersonalbank.com. We've been discussing the two-step process of your personal bank concept. That's step one, set up a high cash value policy to maximize cash growth, maximize dividends, and minimize death benefit. And then the second step is when we want to access funds. One of the ways to do that is through a bank line of credit. And typically you earn more in dividends, you get charged an interest when you access these, so you get to keep the difference. In other words, you get to earn interest on money you spent every year for the rest of your life. And historically speaking, the historical average has been about 2 to 3% positive arbitrage over the last 40 plus years. So it gives you an idea. There's a fail-safe. I'm going to share with you in a bit here how you can't go wrong with it also, especially when interest rates get out of hand and stuff like that. But as I was stating earlier, when you do access funds from these through the bank line, there's no requirement to make payments, principal or interest. If you don't make any payments or you don't pay off the loan, of course, when you pass away, the lender gets paid back through the death benefit that we minimized. Remember, we maximized the cash, the teeter-totter, maximize cash, minimize death benefit, but there still is one. So that is used to pay off whatever's owed to the lender. Your heirs would get the remainder. So you don't ever lose the money. Now, there is good, better, best. And one of the things I share with folks all the time is the best case scenario is when you access funds from these through, say, a bank line, the best thing to do is to pay back the interest only on the loan. There's a couple of reasons why that works so well. Well, first of all, remember, when you access funds, you're accessing them typically through the bank line, not through the insurance company. Remember, you fund the policy to earn dividends, you borrow through the bank, the money's come from the bank, so you borrow against the bank. As long as the dividends are the same or higher than the cost of borrowing, you're ahead of the ballgame, right? It's quite simple. Now, what if you made the monthly interest payments to the bank? What happens? Well, remember, all the money's still in the policy earning dividends, compound every year the rest of your life. You did not remove monies from the policy, did you? In other words, the money's still there. You got the monies from the bank typically. So guess what? The money keeps growing each year, every year, for the rest of your life. Compound. If you understand compound interest, you understand how 1 goes to 2, 2 to 4, 4 to 8, and 8 to 16, and so on. So the longer you compound, the faster the money grows. Compound interest is considered the 8th wonder of the world. Sometimes I've heard that. If you pay the interest on the bank line, the interest on the loan, not the principal, just the interest, what happens? Well, you don't owe any more money to the bank, to the lender, do you? Because you're paying the monthly interest out of pocket. Well, if you do that, what happens is you're now borrowing at simple interest rates. So you're growing the money compound, you're borrowing at simple. Guess what happens over time? You create a bigger and bigger gap over time, which means you have more and more money available that you can then access. Remember, your bank line, the amount you can access is based on how much cash is in the policy. As the cash increases, the funds available in the bank line increase along with it. By the way, you can typically access 95% of the cash value in the policy. I do have a bank that even offers 100% if you want to go there. Their rates are a little bit higher, but you can access 100%. By the way, that's far better than a home equity line of credit or a HELOC, where typically the bank will lend you 80% of the value or the equity in the property. Why is that? Well, if you've listened to the show in any period of time, you know I was a chairman of the board of a bank for a couple of years, so I understand banking far more than most people. The reason why banks will typically only loan you 80% loan to value, say on a home equity line of credit, is banks understand that real estate values can go down. Anybody who remembers 08, 09 remembers that real estate values dropped quite a bit in some parts of the country in particular. And what happened is folks that had borrowed money against their property got underwater. In other words, they owed more than the property was worth. And some of those folks got their notes called, they got their loans called, and then they didn't have the money to pay it back. And it got really ugly for some people. So if you have an insured and guaranteed asset, like the high cash value policies with your personal bank concept, it's guaranteed it will not go down in value. In other words, you're borrowing against an asset that's guaranteed not only to not go down in value, but will actually increase in value each and every year. That is powerful. You want to, if you're going to borrow against an asset, you want to be pretty darn sure that asset's not going to lose value, right? Otherwise, you can put yourself at risk. That's why it's so important and so powerful of a financial tool, borrowing against a policy, because they are insured, they are guaranteed, and they have guaranteed minimums. They're going to grow no matter what. And that's the bottom line. So you never, ever get underwater. So it makes it it's a better asset to borrow against than even a piece of real estate, for example. Now, there's a couple other ways you can access monies from these policies. So let's say, like we've seen, let me go to where we were, let me talk about where we are, and let me discuss where we're headed in terms of interest rates. And then I'll give you some other solutions here I think you'll find very interesting. So if we go back about a couple of years now, we remember that interest rates were really low. The prime rate, by the way, was about 3%. Most of our folks were borrowing money at around 3% range. And the dividends at that point were around 5 to 6%. So here's what was going on. Most people were making 5 to 6% on their money in dividends and borrowing at about 3, which means they had 2 to 3% positive arbitrage on their funds when they accessed and used them. And that's been the average, historical average over the last 40 plus years. Now, if you can make 5-6% on your money insured with guarantees and tax-free, and it only costs you, say, 3% to borrow against it, man, that works every day of the week, doesn't it? Okay? Well, we also know that recently interest rates have gone up significantly, very quickly. It's the fastest increase in the history of the Federal Reserve from a percentage standpoint. And now prime rates are something like 7 and 8.5%, the last I checked. And if you're borrowing at prime or prime minus, you're still at 7.5%, 8%. If you're making a 6% dividend and the cost of borrowing is 7, 8%, that doesn't work, right? But there's a fail-safe. So the second way to access funds from these policies is you can borrow directly from the insurance company. They do what's called policy loans. You have a contractual right to do that. And these loans are set annually, the rates, and they're set at rates that are below market rates. And what it does is it gives you a fail-safe, because here's the thing, the insurance companies don't want to see you get underwater on these. That isn't good for them. That's not good for you. It's not good for business. So on the rare occasions that interest rates climb too high too fast, like we've seen recently, the insurance companies have a fail-safe, a policy loan rate, to make sure you don't get yourself underwater. By the way, you can access them on a tax-free basis, just like the bank lines. It works exactly the same way, the same principles the bank lines do, because insurance companies often own banks, by the way. You don't see banks owning insurance companies, but you do see insurance companies owning banks. They frankly have a lot more money than the banks do. So that's the second way. And there's a third way you can access funds from these that I see some people use that works really, really well. Let's say you have good credit and you have a relationship with a bank. And this is particularly true with local and regional banks, not so much the national banks, because most people don't have enough money for the big banks to really consider you, it's not worthwhile to them because they're just too big. But if you have a good relationship, a working relationship with a local or regional bank, oftentimes you can get sub-market loans and you can pledge the cash in an insurance policy as collateral for that loan. So again, you're leaving the cash in the policy. It continues to grow, interest, insured, guaranteed, tax-free basis, but you borrow money from the bank and you pledge that as collateral. Well, that's called a fully collateralized loan. There's extremely, almost no risk for the bank to lend you that money because they know the cash is there. They know they can access it. It's highly liquid. There's no issue. They prefer to lend that, and they'll give you more favorable rates typically than, say, pledging real estate or other assets, for that example. Because if the bank had to foreclose or they had to collect, there's costs involved to do that on a piece of real estate if you fail to pay back the loan, for example. But with this, it's just cash. It's a fully collateralized loan. There's what's called a collateral assignment. It's very simple. So the bank knows the money's there. They know it's highly liquid. They know it's insured. They know it's guaranteed. They know it's safe. In fact, FDIC considers Tier 1 capital. They rate the tiers of different capital. I've shared this a few times. And Tier 1 is considered the safest capital of all. And there's only 3 assets that fall under Tier 1 capital. And that happens to be cash, cash equivalents, and cash value in life insurance. Banks understand this. Lenders understand this. They would rather loan against cash, cash equivalents, which would be like money market, savings accounts, things like that, or cash value in policies because it's insured, it's safe, it's guaranteed, highly liquid. That's the reason why. Now I'm going to discuss a few more things in the last segment. I'm going to encourage you to stay tuned because there's some with the interest rates the way they are, inflation the way it is, how do you get your money to work for you more? Your emergency funds, rather than sitting there languishing, how can you make that money grow, continue to grow, so that you can have more money to live on? And not only this year, but not only that, thrive. High interest rates, high inflation, economic uncertainty creates chaos on one hand, but on this other side of the coin, it also creates opportunity. And I want to see you, if you're listening to me, I want you to be in a position so that when opportunities do present themselves, and believe me, that's going to happen. If we see a correction in the markets, we are going to see opportunities. Will you be positioned to take advantage of those opportunities, or will you have ridden the roller coaster down, so to speak, and not be in position to have dry powder, have funds available that's readily available, highly liquid, been earning interest for you, not just sitting in cash, losing, because inflation kills that. Your money's growing while you're waiting, and then you can pull the trigger. Are you in position to do that, or will you, when the opportunities that are bound to come down the pike sometime in the near future, will you be ready? If not, stay tuned. I'll teach you how to do it.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, contact me at yourpersonalbank.com. Yes, you will reach me. That's yourpersonalbank.com. So we've been discussing today, what is your personal bank? I get asked that all the time. If you miss the first 3 segments of this show, I'm going to encourage you to go to my website, yourpersonalbank.com, or the app, Your Personal Bank app, and you can listen to this or any of the previously recorded shows anytime you want. Each has its own title. Listen to anything that interests you, but this will be a great show for somebody who's just looking into this idea or somebody that you know may be interested. Send this to them. This will be a great introduction to your personal bank. What I really want to focus on now is, why is this such a good time in particular for your personal bank strategy? Well, the answer comes down to interest rates. Dividends with insurance companies are highly interest rate sensitive. Why? Well, the reason is quite simple. Insurance companies invest a vast majority of their portfolio in bonds, corporate bonds, treasury bonds, things like that. A typical insurance company will have upwards of 80% of their investment portfolio invested in those types of assets. Now, if you've been paying attention to interest rates at all, you know the last decade plus, we have had the lowest interest rate environment in the history of the United States for the longest period of time. That is a statistical fact. I was looking at that one time and said that's the lowest interest rates we've had for the longest period of time since 1787. Folks, that's powerful. That's really powerful when you think about it. And if you understand the old mantra of investing, buy low, sell high, right? You'll start to understand why this is such a good time for this particular tool. I've stated on this show many, many times, the assets that tend to thrive in a low interest rate environment, things like the stocks, real estate, they obviously thrive in low interest rate environments. Cheap borrowing of money is great for business. It allows business to grow, expand. Cheap borrowing rates for real estate obviously benefits real estate values. The assets that tend to thrive in a low interest rate environment will tend to suffer in a higher interest rate environment. The opposite is also true. The assets that don't do so well in a low interest rate environment thrive in a higher interest rate environment. Let me use a simple example most people are familiar with. Have you been to a bank a couple of years ago and you looked at the interest rates, even on longer term CDs, and it was nearly impossible to get even 1% return on a longer term CD, right? Today, you can get CDs, I've seen them in 4 and even 5% range. That is a dramatic difference just in about a 2-year period. I mean, think about that a minute. If you could get less than 1% and a couple years later you're now getting 4 or 5%, you realize that's a 4 or 5-fold increase, 4 or 500% increase on return. Folks, that's massive. That's a massive difference. Why are we seeing such a significant change? Well, it's simple. It's interest rates. And the Federal Reserve has a lot to do with that. The other thing you need to understand is bonds. I stated earlier, bond interest rates are highly interest rate sensitive also. Insurance companies, as I stated, the vast majority of their portfolio is invested in bonds. The returns on treasury bonds today versus a couple years ago are 2 and 3-fold higher, 200 and 300% higher than they were just a couple of years ago. So that gives you an idea that the profits that these insurance companies are earning today are 200 and 300%, 2-3-fold more, double, triple than they were just a couple of years ago. Well, if 80% of your portfolio is now 2 and 3 times more profitable, what happens to dividends? Well, dividends are profits of the company. And if you remember from the first segment, if you were listening to this show, that insurance companies pay dividends based on, if you're a mutual company, there's no, you're not sharing dividends with any stockholders, so you get all the dividend as a policy owner. Historically, dividends have been 7-8% over the long run on average. They're on the low end right now, still at about 6%. Vanguard came out with an article just recently stating they predict, based on what's going on, bond interest rates to increase for the next 5 to 10 years. Not stay the same, folks, increase. Why? One of the biggest reasons has to do with government spending. The federal government is spending more than it receives, and that is increasing. The amount of debt is increasing. What a lot of people do not realize is the federal government cannot just print money willy-nilly. If they want to spend more than they receive, they have to sell bonds. Last fiscal year, the federal government spent about $1.7 trillion more than it received in tax revenues, which means the federal government had to sell $1.7 trillion of new bonds, new debt, to the market, to the bond market, to be able to issue that currency. That's on top of the $34+ trillion of debt that they have to maintain and roll over and sell as each of those terms become, as they mature. So the federal government is selling trillions of dollars of bonds every year, and the amount of that bond selling is increasing dramatically. In fact, this year, it's predicted that the government's going to spend somewhere about 2 to 2.5 trillion more than it receives, which means they'll have to sell even more bonds. Now, who buys these bonds? Sovereign wealth funds, pension funds, insurance companies, big institutional investors. When you have a glut of supply, it's basic supply and demand, folks. Economics 101. When you have a lot of supply, you have to increase the interest rate to entice more bond buyers. That's the only way they're going to buy all these bonds, which is going to force or pressure interest rates on bonds higher. We're seeing that already as we speak. These various auctions that we've been seeing, bond auctions, have been selling at the high end and record high end of interest rates, stuff that we haven't seen in decades, literally. And the reason why is because there's just so much of it. And the investors, the institutional investors, they're not stupid. They understand that the federal government's trying to sell records amount, and for them to buy it, they have to offer them or entice them by paying them higher interest. Again, the Vanguard article and many, many others have predicted that this will continue, and it's obvious. It's basic economics, basic math. The fact of the matter is, folks, until our federal government stops spending more than it receives, there's going to be upward pressure on bond interest rates. And I don't know about you, but right now I see no effort, no majority, either in Congress or anywhere else in government, to incentive for them to spend less. In fact, they just keep spending more, don't they? So until that changes, bond interest rates are going to be pushed higher, which means dividends with insurance companies are also going to continue to be pushed higher. This is going to get interesting as time goes, because what happens as interest rates keep going higher and higher? Dividends will continue to keep going higher and higher. In other words, you have the opportunity to take advantage of a weakness of the financial, what's the word I'm trying to think of here? The financial irresponsibility of the federal government creates an opportunity for you and I. As the debt continues to increase, this will also become more and more of a drag on the economy. Why? Well, if the government's sucking up like a big Hoover vacuum, all the money to borrow, there's only so much money out there to borrow in the economy. If the government keeps borrowing more and more of it, that means there's less and less money available for businesses and individuals to borrow. More supply and demand. If there's more demand, it's going to force interest rates to continue to climb as the government keeps taking up more and more of the available dollars. So there will be pressure for higher and higher interest rates until the federal government backs off or starts spending less than it is. It needs to get back to spending what it receives or even less than so it can actually pay back some of this debt. That would be great. But until those kinds of things happen, we're going to see increasing interest rates. Again, the point I'm trying to make is this creates a tremendous opportunity. We are at a 22-year low on interest rates and dividends. Those are already starting to climb. Every company I talk to has already stated interest rates, or dividends, I should say, will be increasing next year. And they expect them to continue to increase for the foreseeable future. Again, Vanguard stated for the next 5 to 10 years. Why not invest in a tool where it's insured, guaranteed, tax-free, and is likely going to continue to increase probably every year for the next 5 to 10 years even, if not longer? Where do you want your money to be? Plus, it's highly liquid. Again, as we go forward and the economy starts getting more and more stressed, as the government continues to spend more money, as the debt continues to increase, that's going to put more strain on the economy. You need to understand this because that type of stuff will be a drag on GDP and growth and all those types of things. And a lot of people are discussing and are concerned now about even stagflation. Stagflation is high interest or slow growth with high inflation. These are things that the stock market, real estate markets, and things like that will really suffer and struggle, where your personal bank interest rate sensitive assets will thrive. The last thing I want to share on this, I think is super important, is as the government continues to spend more money and incur more and more debt, they'll be under increased pressure to pay down that debt, or increase revenues to be able to pay the interest on the debt at the very least. One of the ways for the federal government to increase revenues is to raise taxes. If you have assets that are taxable, qualified plans, investments that the gains are taxable, which is most investments, you'll be at greater and greater risk of being faced with higher taxes in the future. If your money's growing tax-free, it just doesn't matter what the future tax rates are going to be. So look, if you trust Congress and you want to be subject to the will of what they're going to do in taxes in the future, keep doing what you're doing. If you want to shield and protect yourself from potential future higher taxes due to the higher or increased debt that they are incurring, then you might want to consider your personal bank as in essence, a tax-free bucket of money, creating options to reduce your future tax liability. So not only the money's going to grow, insured, guaranteed, tax-free, highly liquid, it puts you in a better position. And we're likely looking at increasing dividends. I mean, we're going to see higher dividends next year. We know that. And it's probably going to be higher for the next 5 to 10 years. If you want to put yourself in a good position financially to thrive, I'm going to encourage you to check out Your Personal Bank. Contact me at yourpersonalbank.com for more information. I'll be happy to share with you how this could improve your financial position significantly. And I'm going to encourage you to stay tuned. The next week's show, as always, we'll have some more great information to help you thrive through this economic, chaotic situation that we're going into and already started in. And as long as it's on our money, in God we trust.
Listen Tuesdays at noon and Saturdays at 1 to the Your Personal Bank Show for more information. Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Dividend rates and bank line of credit rates may change. For current rates, contact Ference at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422 or yourpersonalbank.com.